Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.
This week on Wall Street Wrap-Up, Ohio's Jim Jordan is no longer in the running for Speaker of the House, and everyone in Congress is heading home for the weekend. Would you like to be the Speaker? It's open. Send them your resume. President Joe Biden is asking Congress for $105 billion for Israel, Ukraine, and some border security thrown in to get more votes. Will he get it? Earnings are coming in from the last quarter for publicly traded companies. Are they meeting expectations? And with rising interest rates and inflation now, how is consumer debt affecting the consumer? And with the war in Israel against Hamas terrorists now into its second week, how will it be affecting the stock market? Tonight, we're going to be talking with Jason Pride. Jason is the Chief of Investment Strategy and Research at Glenmede with over $43 billion of assets under management. With the war in the Middle East and a war continuing in Ukraine, where is he investing so we can too? Jason Pride from Glenmede will be with us coming up. We're here, you're there, and for the next 28 minutes, this is Wall Street Wrap-Up. Hi, and welcome to Wall Street Wrap-Up. I'm Andre Laborde for this Friday, October the 20th. Well, I hope your week went well. A couple of weeks ago, we had Jim Spiro as a guest. Now, Jim is the managing director of Morgan Stanley and a principal of the Spiro Group. So we asked Jim, does the bond market lead the stock market, or does the stock market lead the bond market? And Jim said, now that the bond market leads the stock market. Now take a look at how the Treasury bonds closed today with the 10-year at just under 5%. This week, yesterday in fact, they hit 5%, which had not been seen since 2007. Traders didn't want to go into the weekend with the geopolitical risks of Israel, Iran, Ukraine, and so forth, so they had a flight to safety, not knowing what the weekend would bring. So they bought Treasuries just to play it safe. But why is there so much talk about this 10-year Treasury bond? Well, unlike people like me, if you go to a party, I'll bet the topic automatically doesn't come up with, how about those 10-year Treasuries, huh? Well, the 10-year Treasury is used as a benchmark for your car loans, for your personal loans, home equity lines of credit. But also, take a look at the first row. The 30-year mortgage. On Wednesday, the 30-year mortgage hit 8%. And today, it is down a bit, but from last year in 2022, it's up almost 87%. If you want to buy a home, and if you go back just 2 years to 2021, the cost of buying a home for a mortgage is up almost 150%. And for last month, just over 1.1 million homes were for sale at the end of September, and the supply from 1 year ago in 2022 has dropped by 8%. Now, that is the lowest single home supply since 1982, over 40 years ago. The median September home price rose by just over 2.5%, but the demand has dropped to its lowest since 1995. People are not wanting to sell their homes, which many are paying a 3% mortgage to get into a new one, now at 8%. Now, if you do have the cash, an all-cash offer will get you that much better deal. So, as an example, if you bought the average $400,000 home today and put the standard 20% down, your monthly payment would be an extra $1,000 a month from just 2 years ago in 2021. Mortgage demand is now at its lowest level in 28 years. So, how did our money do this week? All the indexes ended in a sea of red. Top stocks for the week were staples and energy. They were the outperformers. And it was the S&P's worst week in a month. Those hit the hardest for the week were technology, real estate, and consumer discretionary stocks. Real estate stocks, in fact, they fell more than 4% for the week. And this week, the Dow Jones, they closed today down 1.6% for the week. S&P 500, they closed down almost 2.5%. And the NASDAQ, they closed today down just over 3% for the week. According to a recent CNBC poll of 1,000 adults, conducted between October the 11th through October the 18th. About 1/3 poll thought real estate was the best investment to be in, followed by savings accounts and treasuries, and then stock market, and then along with cryptocurrencies coming in fourth. But when you break it down, with those having $50,000 or more invested, stocks jump ahead of real estate, not by much though, and crypto drops to only 3%. Now, for those saving for retirement, over half of those surveyed have nothing put away for retirement, while the remaining 46% of that group that did have some retirement savings, 60% had invested $50,000 or less. And interestingly, when broken down by age of investors that have started saving, the largest group actually are the 18 to 34-year-olds, with over half of them are focused on retirement and are followed by 51% of those aged 35 to 49. And if you even get closer to retirement, those closer to 65 and over are the groups least prepared. Now, in the survey, as far as leadership, 45% responded that they were better off financially under Donald Trump, and 14% were better off under Joe Biden. And those surveyed, just under half, at 44%, were disadvantaged by high interest rates, while 11% said that they thought higher rates were an advantage. So, how should we invest for these days of war raging in Israel, and that may grow larger if Iran and Lebanon's Hezbollah do get involved? Just about half of the companies have reported earnings from the third quarter. And is the fourth quarter going to be better? Joining us tonight to talk about this and other things is Jason Pride. Jason is the Chief of Investment Strategy and Research at Glenmede, with over $43 billion of assets under management. Hi, Jason. Welcome to Wall Street Wrap-Up.
Andre, thanks for having me on.
We're actually October the 1st, we started into our fourth quarter. And so far, we're starting to get the returns from companies from their third quarter. I know we're not even halfway yet, but so far of what you're seeing, are you satisfied?
Earnings-wise, we've seen now 3 quarters in a row of negative earnings growth for the average company across the broad large cap marketplace. We're now heading into a third quarter earnings reporting season here, and it's kind of borderline, right? So if you were to tell me, hey, you're gonna own stocks and they're gonna not deliver earnings growth for 4 quarters in a row, probably say I'm not a very happy investor. But then if you look at actual market returns, I think that's something different, right? So on a year-to-date basis, we've seen markets up a pretty good degree. This last quarter was a little bit more on the negative side, but generally speaking, we've seen positive returns throughout the year. End result of that is we've seen an appreciation in stock prices, but not an appreciation in the base value of earnings that those businesses are actually generating for us.
They're still spending in spite of higher interest rates?
Right now, that's absolutely the case, right? We've seen a pretty significant input into their savings accounts from recent stimulus efforts. We've also seen a pretty decent repayment on their basis in prior years of excess debt. And now what's happening is, well, they had paid off credit cards, they had built up savings. They now have a little bit of luxury as they work through that excess savings or that debt that they previously paid off to actually support their spending. All that excess savings that we got during COVID, all the debt payments that we got made at that point in time, we've now worked through a lot of that excess savings, and we've actually started to leverage back up with credit cards or other loans at the consumer level. And at some point in time here, back end of this year, we're probably going to find that the consumer is a little bit more tapped out than it was earlier this year.
Jason, do you think that when that consumer starts getting tapped out, do you think it'll be right before the holiday season?
Interesting, I think it's going to depend upon which bucket of the consumer you're talking about. Mm-hmm. The lowest tier, so say the bottom quartile of consumers, they've actually already moved through a majority of their excess savings, so they're probably going to have a little bit harder of a holiday season. The middle of the consumer spectrum actually sits pretty well at this point in time. They're drifting downward. Savings are still there. That's probably more of a first quarter phenomenon. And then there's the top end of the spectrum, which when we're talking about excess savings, look, in top end of the spectrum, it's do you have a good amount of savings or do you have a lot of savings? So it probably doesn't matter as much for them yet. So I think it probably hits the bottom quartile of consumers at the start, and then it starts drifting into the middle half of consumers as we enter the beginning of the year.
Normally, the three worst months are usually on average of August, September, and February. And sure enough, August was down, September was down. And since October the 1st, we've had some down days, but for the most part, we've had some very good days in the stock market. Do you think they're going to rally on, or do you think it's more of a head fake?
I think it's really hard to call market movements on a very short-term basis. Reality is our starting point here is stocks are starting at about a 75th percentile valuation level. That's meaningfully above their normal starting point level or the more normal fair value level, which means that there's some downside to stocks in terms of valuations. If you take that into account alongside with what we see as ongoing recession risks as we enter the back half of this year, you put those two together and you kind of wonder, well, why is the stock market actually pricing at this 75th percentile level? Is this justified? We think it's not quite as justified, and therefore the market's on more tenuous footing. Having said that, we've seen environments where markets actually sustain themselves at these high valuations for a prolonged period of time due to a lot of liquidity sloshing around in the markets.
Jason, last week we had a guest, Steve Eisman, on, and he said he had a saying that the recession was the most anticipated recession that never occurred. So I'm curious, when you bring up recession now, do you still think that there's a possibility or there a probability of either toward the end of this year or possibly into 2024?
He's absolutely right. This is the most predicted recession that we've seen in quite a long time. People started calling for the recession in, say, middle of last year. And so we've been an entire year without actually seeing it come about. Now, why did that happen? That happened because of that excess savings we talked about earlier, how good consumers were in their position, and then that run of compensation increases with wage gains that we've seen pass through the consumer. Those things have kind of kept the economy alive and well. We've raised interest rates a lot. We're now at a point where the average mortgage is well over the existing mortgages outstanding. If a consumer or a business goes around and tries to get a new loan for their next round of purchases or business expansions, they're going to find that loan probably costs twice as much as it did just a year and a half ago. And that's probably going to put some of them in a position of saying, well, maybe I'll put that off another 9, 12 months. Those are the circumstances that historically have created recessions. Now, having said all that, our expectation is this is not one of those dire 2008, 2009 recessions. We think there's still a pretty decent chance that a recession occurs. It's not a guarantee. If and when it does occur, it's likely going to be one of the kind of more routine, mild variants, right? Sort of declines in GDP, which doesn't feel horrible, but it probably still doesn't feel quite as good as a 2 or 3% growth run rate.
Larry Fink, the CEO of BlackRock, was on another financial show, and he brought up an interesting point. He said in the last 23 years, we've raised the federal deficit $25 trillion, and he said it's evident that Congress, because politicians love to spend money, they're not going to be cutting. So the only way is to grow the economy more and more. So like what you're saying about the GDP, do you see that our country is going to be able to keep ahead of the deficit?
Look, longer term, 2-3% should be achievable by this economy, right? We've got a decent economy that operates on a pretty good basis and in majority of market cycles, right? We have a fairly entrepreneurial spirit. New businesses are formed every day. New people are hired on that basis. We have new technologies that come about, like artificial intelligence recently, that help drive us forward. So we actually are, even though we may be a little bit concerned on a near-term basis, we actually are longer-term bulls for the economy and the market. In terms of the debt for the federal government, we're at a pretty lofty level in the magnitude of debt that we put out there. And now we're having to pay, as a federal government, we're having to pay more and more on that interest. It actually takes a long time for that to kind of seep in. And therefore, there's going to be pressure on politicians to try to contain that budget. That budget already at this point in time is now to about 13, 14% of their revenues that they take in every year are actually dedicated to paying interest on existing debt. As that creeps higher, that's going to be harder for them to keep the spending level at the levels they have.
A 2-year Treasury and a 5-year Treasury has now been paying more than the 10-year and a 30-year. But we've seen 2-year Treasuries paying in recent days and weeks over 5%, and even the 10-year and the 30-year paying over 4%. Are they going to have to keep continuing raising the yields? Well, the Federal Reserve is now selling the bonds that they were having, and other countries are not buying them at the rate that they were.
Well, I think we need to clarify a couple of things there. Number one, the Federal Reserve is actually letting existing bonds roll off or mature out of their portfolio as opposed to actively selling. It kind of has somewhat similar effects, but it is a little bit nuanced and different from that. The second thing that we need to consider is that when you look around at global pools of debt, U.S. government debt is one of the largest pools of AA or better rated debt that pays one of the most attractive interest rates out there. I know, look, the hands that actually own the bonds are going to change. China maybe doesn't want to own as much. Maybe Japan at a certain point in time doesn't want to own as much. But that doesn't mean there's probably not going to be demand for those bonds. When you have a AA rated credit paying this level of interest rates, you're going to find buyers. So we're going to see increased political pressure. That's where it's going to sit. It's already sitting there. We've already seen some strife or conflict within Congress, coming up with recent budget deals, coming up with recent budget announcements and deals, and the recent shutdown debate that recently occurred. That's already caused the casualty of one head of Congress. This is probably going to be an ongoing thing for us to actually have to deal with within U.S. politics, because it's really easy when your budget is kind of easy to make and easy to meet. But once you get to a point where your country is a little bit more levered up and the budget decisions are a little bit harder, you're going to have more arguments.
What about right now the war that's going on in Israel and against the Hamas terrorists? Have you, at Glenmede, have you changed your investment strategy any to work with global situations around the world such as this?
So we're always thinking about geopolitical risks. And before we even go there, I think the first thing that we have to say and recognize is that we have to recognize that this is a humanity issue first, and it's an investment risk issue second.
True.
There are a lot of people impacted by that, and it's horrible to hear and see the stories of what's going on within Israel, within Gaza. In terms of their investment impact, neither of those are hugely large pieces of the global economy, but this is a globally interconnected economy that we live in. Our most likely case at this point in time would be having some situation where Iranian sanctions may be reemphasized, or something happens that causes Iranian supply of oil into the market to decline. If that were to do that, would tighten up some of the oil supply on a global basis and could lead to some additional inflation pressures on top of inflation that we've obviously already been experiencing over the last couple of years.
Well, that's a good point, Jason, because the IEA, the International Energy Association agency said that they're expecting oil, because of the war, oil to be going up higher. And I remember before the attack occurred with Hamas against Israel, Goldman Sachs had said that they thought oil would be reaching $100 a barrel. Do you see, or do you foresee probably oil, especially if one of the black swans like you were just mentioning may occur? Do you see that the spike of oil will going higher? And what would this do to what we talked about before, you think, with the possibility of inflation?
Look, we often don't spend a lot of time forecasting exact oil prices. But having said that, you can imagine a scenario where, given the pressures, given the rise in oil now that we've seen so far, which is rebound from the levels after it pulled back following this last round of inflation, we're now seeing it kind of inch back up, right? The last couple of days, I think we've seen a little bit of a back off, but you could very easily envision a scenario, particularly surrounding Iran, in which oil supplies maybe stop or get disrupted in some form or fashion, and that could cause one of these more difficult environments. I think investors have to recognize that that is a risk, and it becomes a more pronounced risk anytime there's military conflict in these regions.
What about cash? Do you recommend to your clients right now that because of the circumstances and the situations around the world, also the interest rates we've been talking about just recently, do you recommend to your clients having more cash than equities?
Cash is now paying in excess of 5% for investors, and you can get bonds that actually pay you somewhat similar sort of yields. Asset classes that are more defensive in nature, paying you 5%, when equities are actually sitting at the higher end of their historical range, actually feels like a pretty decent risk-reward trade-off, right? So, in result of that is we've been underweight equities to a modest degree. We've had an overweight to cash and fixed income as a result of that.
Well, if with that thought too, Jason, do you think more people will be taking out their deposits from the bank if they're getting a lower interest rate and putting them into securities that, like what you're saying, that are paying 5%, 4% yield?
Look, we think that's actually been a game that investors have actually been playing for a little bit of time now, right? If you look around the marketplace, money market funds have been paying more than what your average bank will pay. Whereas, money market funds are meant to be asset gatherers. They offer probably generally the most attractive yields competitively, and they try to generate those attractive yields by properly placing the money in short-term investments that carry the best risk-adjusted reward on that shorter-term basis. Generally speaking, money markets will carry a higher yield than banks. Lately, we would argue that it's actually been even more pronounced than normal because as rates have come up, money markets have priced those rates up to match what the Federal Reserve has been doing on a more rapid basis, because that's what the markets could provide, whereas banks have been a little bit slower to creep up their deposit rates that they pay for people placing deposits at banks.
Well, I had read where there's something like 6 out of every 10 new mortgages now are not made through banks, but through other institutions. As a sector, do you think banks are a good area to be investing?
Well, rising interest rates sure should favor banks over time, right? They make money on the spread between one interest rate and another. When interest rates are higher, they tend to actually be able to push up the rate that they collect a little bit faster than the one that they actually pay out. And generally speaking, when rates are higher, they actually have a little bit more room to build in that cushion for their net interest margin. So this should be an environment that generally is a little better for banks. Having said that, we've seen an environment where banks had some issues with placements of risks. They now have a situation where majority, if you're thinking about regional banks or even small banks, a lot of those banks are backers of commercial real estate, a good portion of which is office real estate. That is one of the primary issues facing banks right now, and something that's crimping that supply of cash. Probably the reason that you're seeing other issuers of mortgages step in instead that are not the banking channel.
Do you see a harbinger of problems ahead with so many mortgages being held by commercial real estate by banks that, landlords, if they're not getting the tenants in there and they don't have the money to either pay the mortgages, the banks will either have to roll them over, or because they certainly wouldn't want the real estate.
Look, it's pretty much a guarantee that whenever we have pretty big swings in interest rates and big swings in asset values, so we've seen both of those occur with interest rates and with expected values of office real estate in particular, you're going to find in the banking industry that somebody is wrong-footed, right? It's just kind of part of the game. It's like in the investment game when anything moves in a dramatic fashion investment-wise, likelihood is somebody is flat-footed and somebody's actually sitting in really good positioning, making money on the other side. So we wouldn't be surprised if we see some spots of issues pop up over time. Counter-argument is the Fed has actually been pretty active in trying to figure out those situations and provide liquidity to those banks in order to try to make any of those more difficult situations more palatable for the overall system. And they've been very proactive on that front. I would expect they're probably going to remain very proactive in any situation that develops.
With the Federal Reserve being proactive the way they are, what are you advising your clients as far as like maybe sectors? So let's say if the interest rate, the Fed rate is, let's say, between 5.25% to 5.5%. Are there certain sectors you like, and there may be certain sectors you want to stay away from?
So I'll broaden that out a little bit for you, but let's start with the sectors first, right? In terms of sectors, we'd favor your more defensive or staple-oriented sectors right now at this point in time. One of the areas that we actually find relatively compelling is healthcare, and within healthcare, things like HMOs actually look like they're fairly reasonably priced for the magnitude of earnings generation and stability that they're able to generate. When you look around the rest of the sectors, you have things that look like they're stable with technology, but they're priced at pretty extreme levels. And then you have other portions of the market that are more volatile in nature. They're actually, they may be priced at discounts, but they're more sensitive to the economic swings. And if you look overseas, it's interesting to see that pretty much majority of the international markets are actually trading at discounts to our assessment of fair value. Probably the most attractive there for us is actually Japan. Japan is an area where their economy and market has actually been generating earnings growth that's similar to what we see within the US, but just not getting credit for it over time. And they still trade at valuation discounts that are below Europe and below the US. It actually looks pretty attractive to us.
Jason, there's a lot more we're going to be getting into. I sure hope you come back.
It's been great being on here, Andre.
Thank you a lot, Jason. Hey, if you have a question, maybe a comment about the show, we'd love to hear from you. Make it concise, make it pithy, and write us at andre@benacapital.com. Well, next week's earnings, we're going to kick off with high gear with tech companies as Alphabet, Google, Microsoft on Tuesday, Meta, formerly Facebook, is going to be on Wednesday, Amazon, and even ExxonMobil. So do the world events as what's happening in Israel or Ukraine have anything to do with the markets? How should we prepare for the remainder of this year and going into next year of 2024? Next week, we're going to be talking with the Chief Investment Strategist and Managing Director for CFRE, Sam Stovall. Now, in addition, Sam is also the Chairman of the S&P Investment Policy Committee. And the knowledge of Sam has in the S&P and market history, well, Sam is amazing. Sam Stovall next week. And that's a wrap-up for our show this Friday, October the 20th. Our thanks to Jason Pride for being with us tonight. Always, though, we appreciate you for allowing us into your homes this evening. Have a fun weekend with the ones you love. I'll be here next week. Remember, if it's Friday, it's Wall Street Wrap-Up. I'm Andre Laborde, and always remember, money never sleeps. Good night.
Wall Street Wrap-Up is supported by Bamboolas, featuring live music and coming soon, tapas and wine upstairs. Bamboolas, the heartbeat of Frenchman Street.